Leave the SEC alone. Because in this made-up story, the real fight is happening in the boardrooms of Wall Street's most powerful companies, not in the courts. This is the hidden story of how JPMorgan, a trillion-dollar bank, quietly got ready for a change that would be so big, so disruptive, and so permanent that not even people in the crypto community could understand what was happening. In this made-up story, it all starts with a memo, which is a private briefing that is sent to a small group of top executives. The corporate confidentiality codes and limited distribution labels on the memo say that XRP is more than just a digital asset. It also talks about it as a possible liquid treasury instrument that could fix liquidity fragmentation in a future where tokenized finance is the norm. Its effects are felt in every part of global banking, like the sound of a quiet explosion in this story. The paper is very clear and analytical, and it talks a lot about settlement latency, corridor liquidity costs, and how efficient synthetic liquidity provisioning is supposed to be. But it's the almost philosophical language in the last part that gives us a hint of how big of a change these made-up executives think will happen. It says that standard banking systems won't be able to compete in a world based on CBDC unless they are backed up by a neutral, self-governing settlement system. Music. In this alternate world, XRP is the most important thing, and as soon as this memo is written, modern finance starts to fall apart. While some banks fight back, others fear. But some people who know how quickly the world's digital landscape is changing start quietly gathering, placing, and getting ready. This story is about how JPMorgan's internal analysts build models that run thousands of simulated liquidity stress situations involving tokenized assets, derivatives, cross-border settlements, and CBDCs. Their research shows that a bridge asset is necessary in a world where digital money systems are broken up, and currencies like the European Central Bank's ECB, CBDC, China's ECNY, the Middle East's regional digital dinar, and rising market currencies don't all work with the same rules. The made-up experts say that the best option is not a stable coin, a central bank system, or a digital dollar, but a neutral asset that has already been distributed and is meant to be settled for good. The banks don't use XRP in this case because they love crypto. They use it because world settlement wouldn't work well without something like it. Still, the plot gets more complicated. At the same time as these internal simulations, a group of made-up banking futurists start sending around unofficial research papers in private, claiming that XRP's escrow, which has been criticized for a long time, may actually work as a stabilizing pool for high liquidity operations. They want to use escrowed XRP as a programmable liquidity reserve that can be used in structured pits to help banks when they are under a lot of stress. In this video world, the structure is like a current software-based version of treasury operations, but it is faster, cheaper, and can work with systems all over the world. As the made-up story goes on, whispers start to spread at private banking meetings. Senior execs talk about digital transformation projects speeding up in ways that aren't made public. They talk about how CBDC beta tests showed unexpected problems when they were used with old settlement rails, and a quiet nod of agreement spreads. These devices need to talk to each other, so the same question keeps coming up in fancy but tense meeting rooms from New York to London to Singapore. What do we use as the bridge for everyone? In this story, banks work on the asset they use to make fun of behind closed doors, away from small buyers. This is where the made-up anonymous bank experts show up, not the loud, controversial people you see on social media, but experts, risk modelers, macro planners, and algorithmic liquidity engineers who work for the company itself. They make private, secret projections that show how much XRP might be worth if it were used on a large scale across wholesale payment networks. These projections were never meant to be made public. Their models are not like Bitcoin hype charts in how they look or act. They work like the liquidity depth studies that are used for commodities and government debt. And when stress situations like global liquidity shortages, geopolitical shocks, and CBDC fragmentation are tested, the models keep coming back to the same shocking result. In the made-up world of this story, a high three-digit valuation is theoretically possible if it is used on a large scale. That's just the start, though, because this story isn't about predicting prices. It's about fixing up the structure. There are no traders among the huge banks in this made-up world. These people are builders who are making plans for the buildings of the next 100 years. They don't care about short-term changes in the market. They care about long-term settlement authority. As their models get more stable around situations in which XRP is used as the settlement layer, they make backup plans. The digital strategy outlines of whole departments are being changed. The shift starts slowly and quietly. In the meantime, the world still doesn't know. Small buyers fight over charts. People with a lot of power argue about regulations, and people who don't like XRP say it doesn't matter. But behind soundproof glass doors, the world's biggest banks are planning for a future where payment doesn't depend on a single government or currency. They are not picking XRP because it is perfect in this other world. It's being chosen because, well, it's neutral, quick, and can automate cash flows with a level of accuracy that old systems never could. And to be honest, having a neutral bridge is just as important in a world where CBDCs control monetary policy as SWIFT was in the 20th century. By the middle of this made-up 80-minute trip, the stress really starts to rise. There is a new wave of internal research going around. The people behind this one work in tokenized stock markets all the time. In a near future situation described in their report, trade finance, interbank loans, stock settlements, and bond issues will all be handled as tokenized instruments that work on separate networks. It turns out that interoperability is the weak point. If these networks can't talk to each other quickly and cheaply, the system turns into a maze of ledgers that don't work together. The experts say it again, there needs to be a bridge, but not just a bridge for money. There needs to be a bridge for value itself. In this made-up world, banks start to see XRP not just as a token, but also as a way to pay multiple assets. Its ledger turns into a global interpreter that can translate between token formats. This makes atomic settlement possible and lets money flow between markets without the problems that come with standard rails. As these ideas become more popular, banks change the way they talk about XRP. It is now called a neutral liquidity substrate, routing layer for tokenized value, and even backbone for wholesale digital finance. The change isn't just an idea anymore. It turns into, well, smart. From here on out, the story takes a dramatic turn. Banks start to use simulated XRP corridors for multi-bank liquidity drills and work together across test networks to see how they react to stress. The findings are very shocking. Settlement efficiency goes up, liquidity redundancy goes up, and business risks go down. Even the most conservative leaders who used to completely reject the idea are now starting to think again. They know that they can't stop the development of digital settlements. No longer is the question whether we should use a bridge asset. The question is which bridge asset will last in the long run.